Welcome, everyone. Today, we are diving into Volume Profile, a powerful tool that can help you become a more confident trader. If you have ever wondered how to spot where most of the trading action happens, or how to find key price levels that might affect your trades, you are in the right place. By the end of our time together, you will know how to use Volume Profile to identify support and resistance, confirm the direction of trends, and find the best spots to enter or exit trades. So stay tuned because we are going to explore strategies and tactics that will help you sharpen your trading skills. Let us start by diving into why Volume Profile is such a game changer for traders. Imagine being able to pinpoint not just the amount of trading happening, but also the exact price levels where that trading is taking place. That is what makes Volume Profile so powerful. Unlike traditional volume indicators, which show how much trading occurred over time, Volume Profile gives you a detailed look at the price levels where the most significant trading action has happened. Picture a chart with trading volume plotted along the price axis, revealing the areas that the market cares about the most. These high-volume zones can become crucial decision points for future market movements, giving you the edge to anticipate where support and resistance are likely to form. Now, let us dive deeper into the types of chart patterns that often emerge when you are analyzing Volume Profile. One common pattern is the *** balanced profile ***. This pattern forms when the volume is distributed fairly evenly around a central price point. It looks like a bell curve on the chart and suggests that the market is in a period of consolidation. When you see this kind of pattern, it is often a sign that buyers and sellers are in balance, and the price may stay range-bound until there is a catalyst for a breakout. Another important pattern is the ** trending profile ***. In this pattern, the volume distribution tends to be skewed in one direction, either upward or downward. This kind of profile tells you that the market is moving in a clear trend, with volume supporting the movement. When you see this, it is usually a good idea to follow the trend, as the volume confirms the direction and strength of the price movement. The ** double distribution profile ** is also worth mentioning. This pattern is characterized by two distinct areas of high volume with a low volume area in between. It can signal that the market has shifted from one price range to another, and the low volume area between these high volume nodes can act as a fast-moving transition zone. This kind of profile can provide opportunities to trade breakouts when the price moves between the two distribution areas. Lastly, there is the ** P-shaped profile ***, and the ** B-shaped profile ***. The ** P-shaped profile ** often forms after a short squeeze or a rapid upward move, showing high volume at higher prices. This suggests that buyers are in control, and the market may continue to move higher unless there is significant selling pressure. The ** B-shaped profile ***, on the other hand, is often seen after a significant sell-off. It shows high volume at lower price levels and suggests that sellers have exhausted themselves, which could mean a potential reversal or consolidation. By understanding these chart patterns and how they relate to Volume Profile, you can gain deeper insights into market behavior and improve your ability to make well-timed trading decisions. Identifying these patterns can help you better understand whether the market is trending, consolidating, or preparing for a breakout. All right, let us break down some of the key pieces that make up Volume Profile. One term you will hear a lot is the point of control. This is the price where the most trading activity happened. Think of it as the balance point between buyers and sellers. It is an area where traders spent a lot of time agreeing on price, and because of that, it can become a very important level to watch as price moves again. Another important part of volume profile is what we call the value area. This is the price range where most of the trading happened, roughly 70% of it. If you think about it, that is where most of the market action takes place, and those price levels often become significant. There are two edges to this value area, and they are called the value area high and the value area low. These are like boundaries. When the price pushes above or below them, it can give us signals that something might be shifting, maybe a breakout or a reversal. Now that we understand some of these pieces, let us talk about how to set up and read volume profile. First, you will want to choose the right time frame depending on the kind of trading you do. If you are trading throughout the day, you might use a daily or even an intraday volume profile. If you are more into swing trading and want to understand longer trends, then a weekly or monthly volume profile might be more useful. Once you have set it up, you will look for areas that stand out. The places with the highest volume, called high volume nodes, are where price has spent a lot of time. These often become key levels for support or resistance. In addition to choosing the right time frame, it is also important to understand some common chart patterns that appear when analyzing volume profile. One such pattern is the ** distribution pattern **. This pattern forms when there is a clear area where the majority of trading has taken place, which usually indicates a fair value zone. It looks like a peak or mountain in the volume profile. When price revisits these high volume zones, they tend to act as support or resistance, depending on the direction of price movement. Another important pattern is the ** accumulation pattern **. This appears when trading volume starts to build up at a particular price level, indicating that large players might be accumulating positions. It suggests that the price could be preparing for a larger directional move. Recognizing accumulation patterns early can provide a valuable opportunity to enter a trade before a major breakout occurs. A ** thin profile pattern ** or ** low volume profile ** is another significant formation to watch. This pattern is characterized by little trading activity at specific price ranges. Thin profiles usually indicate areas of price rejection, meaning the market did not spend much time there. These areas can often act as fast lanes for price, allowing for quick moves when revisited. Traders looking to catch breakouts or breakdowns often find thin profile patterns useful for timing entries. The ** volume bulge pattern ** is another pattern to be aware of. This pattern shows a significant increase in volume at a certain price level, forming a bulge on the volume profile chart. It often indicates a level where significant buying or selling interest has taken place, which can subsequently act as a major level of support or resistance. When price revisits these levels, you may expect a strong reaction, such as a bounce or a rejection. Lastly, consider the ** volume node transition pattern **. This pattern forms when price moves from a high volume node into a low volume node. This transition often signals an impending rapid price move, as the low volume area lacks the liquidity needed to support slow movement. This pattern can be particularly useful for breakout traders aiming to capitalize on quick directional moves. By being familiar with these various volume profile patterns, you gain the ability to better interpret market behavior and make more informed trading decisions. Each pattern offers different insights, from accumulation to potential breakouts, and understanding them thoroughly can improve your overall strategy. It is also helpful to recognize some specific chart patterns that can form when looking at volume profile. One such pattern is the *** volume spike at key levels ***. This happens when a particular price level shows a sharp spike in volume compared to the surrounding areas. It often indicates significant interest at that price, and it can mark a turning point or the start of a new trend. When you see a spike at an important level, pay close attention as it may signal an opportunity for a trade. Another pattern to watch for is the ** volume gap **, where there is a noticeable lack of volume in a particular price range. These gaps are usually formed when the market moves quickly through an area without much trading activity. This can mean that the price is likely to move quickly again if it re-enters this range, offering a potential opportunity for breakout traders. A volume gap can indicate either a lack of interest or that the market found the price to be fair and moved on quickly. The ** consolidation zone * is another crucial pattern to understand. This is where the volume profile shows sustained volume over a narrow price range, suggesting that buyers and sellers are in balance. When the price finally breaks out of a consolidation zone, it is usually with strong momentum, as traders decide the next direction. This makes consolidation zones key areas to watch for future price moves. Finally, the ** volume shelf * is a pattern where there is a plateau in the volume profile at a particular price level. It resembles a shelf with volume building up at a steady rate over a given price range. Volume shelves are significant because they often act as strong support or resistance levels. When price approaches a volume shelf, you can expect it to either bounce off or break through, often with increased activity. Understanding these patterns helps you make more informed decisions about the strength and sustainability of price movements. There are also low volume nodes, and these are places where the price moved quickly and not many trades happened. When the price hits these areas, it often moves fast again. That makes these areas good to watch for potential breakouts or breakdowns. Imagine a price zone with not much activity. When the price gets there, it tends to cut through like a knife, making those areas especially interesting for breakout trades. Now let us talk more about using volume profile to find support and resistance. When you see those high volume nodes, think of them like magnets for price. The market likes these levels because it spent a lot of time there. These spots often become support if the price is above or resistance if the price is below. This is because traders are comfortable at these prices and they represent areas of high acceptance. The price tends to consolidate around these nodes, making them reliable levels to watch. Another interesting pattern to consider is the ** volume clustering **. Volume clustering occurs when high volume nodes are close together in a tight range. This usually suggests a strong zone of accumulation or distribution, which can act as a significant barrier for price movement. These clusters often develop after periods of heightened market activity and represent areas where both buyers and sellers have found value. When the price approaches this cluster, you can often expect a strong reaction, either a rejection or a decisive breakthrough. Typically, a rejection from a volume cluster suggests that the market finds the price to be fair, thus leading to a bounce back into the range. Conversely, a decisive breakthrough may occur when market participants see a compelling reason for the price to move away from this fair value zone. These areas are great places to watch for potential trade setups, as they provide clearly defined levels for placing stops and targets. Understanding whether price is likely to reject or break through a volume cluster requires careful analysis of momentum, the broader trend context, and whether any catalysts are driving the move. In contrast, **volume voids ** are areas where there is little to no volume. These are also known as low volume nodes or voids. Price tends to move quickly through these areas because there is less agreement between buyers and sellers. This makes volume voids excellent zones for breakout trading, as the lack of volume suggests that the price can travel through them with little resistance. When trading these voids, it is important to watch for increased momentum and to be prepared for rapid price movements. Another key pattern to observe is the ** volume-led reversal **. This occurs when the price reaches a high volume node and fails to break through, indicating strong rejection. If you see a high volume node that repeatedly holds as support or resistance, this is often a sign that a reversal is likely. Volume-led reversals can offer great risk-reward setups, especially if they align with other technical indicators such as trend lines or moving averages. Lastly, let us not forget the importance of **, volume contraction and expansion **. Volume contraction happens when trading volume starts to decrease over a range, suggesting a period of uncertainty. It often leads to a breakout, where the subsequent expansion of volume confirms the new direction. When you see volume contracting, it can be a signal to prepare for a potential trade, while the expansion of volume afterward can confirm your entry. By recognizing these different chart patterns and understanding how they relate to volume profile, you can significantly enhance your trading strategy. High volume nodes, volume clustering, volume voids, and volume-led reversals all provide valuable insights into market dynamics. The more familiar you become with these patterns, the better equipped you will be to spot opportunities and make well-timed trading decisions. Volume profile is also excellent for confirming trends. Here is how. If the price is going up and you see that the volume is gathering around higher and higher price levels, it is a sign that traders are actively supporting this uptrend. The market is accepting higher prices, and that is a good signal that the uptrend may continue. The same idea works in reverse. If the price is falling and the volume gathers at lower levels, then it is likely that the downtrend will keep going. You can use volume profile together with other trend-following tools to help confirm whether the price is likely to continue in the same direction. All right, let us get into some specific trading strategies using volume profile. First up, we have the strategy of trading with support and resistance. Here, you look for those high volume nodes to identify the strongest support and resistance zones. If you see price approaching a high volume area, it might bounce off, and that could be a chance to enter a trade. Or if it breaks through, that might signal the start of a bigger move. Another strategy is using low volume nodes to trade breakouts. Since the price tends to move quickly through low volume areas, they make for interesting opportunities to catch a breakout. Imagine a price level where there has not been much trading. When the price enters that area, it can move swiftly, and that makes it a great opportunity to enter the market. Finally, let us talk about spotting trend reversals. When the price gets to the point of control or to the edges of the value area, pay close attention. If the price gets rejected there with strong volume, that can be a sign that the trend is about to reverse. Watch for these moves because they can offer high probability setups to enter the trade as a new trend begins. Combining volume profile with other indicators can make your analysis even more accurate. Moving averages can be helpful to confirm trends. If the price is near a high volume node and also above a key moving average, that is a pretty strong signal that the trend might continue. You can also use an indicator like the Relative Strength Index to help spot if the market is overbought or oversold. When you see these conditions alongside key levels from the volume profile, it can help you decide if it is time to enter or exit a trade. Another great combination is with Fibonacci retracement levels. If the price is aligning with a key Fibonacci level and also near a high volume area, that can be a great sign of a strong support or resistance zone. Fibonacci retracement works particularly well with volume profile because it helps identify levels where the price is likely to react, especially when these levels coincide with high volume nodes or points of control. This confluence can provide a higher probability setup for trades, making it a valuable addition to your analysis. You could also consider using Bollinger Bands alongside volume profile. Bollinger Bands provide insight into volatility and potential reversal points. When price moves outside of the bands and aligns with a key volume level, it can indicate that the market may be overstretched and ready to pull back. This combination is particularly useful when trying to time entries or exits at extreme market conditions. Another helpful indicator is the MACD or moving average convergence divergence. The MACD is useful for identifying momentum shifts. When you see a MACD crossover in conjunction with price reaching a key volume area, such as a high volume node or point of control, this can be an excellent confirmation that a trend change is occurring. Combining the MACD with volume profile helps reduce the noise and gives you a clearer picture of potential reversals or trend continuations. Lastly, you might want to use support and resistance levels derived from traditional technical analysis along with volume profile. Volume profile levels are based on trading activity, while traditional support and resistance levels are based on historical price action. When these two types of levels align, it suggests a stronger barrier to price movement, making these areas ideal for entry or exit points. You can gain more confidence in your trade setups when multiple types of support or resistance align with key volume levels. Risk management is a huge part of successful trading, so let us talk about how you can manage risk while using volume profile. When you place your stop losses, consider setting them just beyond important volume profile levels like the value area low, the value area high, or the point of control. This way, if the price breaks through those levels, you are protected in case the market moves against you. This method helps ensure that your stop loss levels are placed where the price is less likely to go unless a significant market shift occurs, giving you added safety. Another thing to consider is your position size. Larger positions can be safer when the price is trading around high volume areas, as these areas often have stronger support and resistance due to higher market activity. High volume nodes act as stabilizing forces where the price is likely to consolidate. This makes it more predictable and less risky for larger trades. On the other hand, if you are trading in a low volume area where price tends to be more volatile, it might be better to use a smaller position to manage the risk. Low volume nodes are known for rapid price movements and can lead to increased unpredictability, which makes reducing position size essential for minimizing potential losses. Additionally, you should consider the importance of diversifying your risk by not placing all your trades in the same high volume or low volume areas. Spreading your trades across different market conditions can help balance your risk exposure, allowing for a more consistent trading outcome. Also, keep an eye on the broader market context. For instance, major news releases or economic events can drastically alter market dynamics, causing even high volume nodes to fail as support or resistance. By adjusting your position size and stop-loss placement based on volume profile levels while taking the overall market conditions into account, you can enhance your risk management strategy and protect your capital more effectively. Now, let us discuss some common mistakes traders make when using volume profile. One mistake is putting too much emphasis on low volume nodes without confirming with other indicators. While low volume nodes are interesting for spotting breakouts, they should not be the only reason you enter a trade. Always confirm these signals with additional indicators such as moving averages, trend lines, or momentum oscillators to improve your accuracy. Another mistake is ignoring the bigger picture. Volume profile gives you great insights, but always remember to consider the broader market trends, any major news events, and the overall sentiment to make sure you are not caught in a false move. It is important to cross-reference what you are seeing in the volume profile with other context, such as macroeconomic conditions, sector performance, and overall market volatility. Ignoring these factors can lead to poorly timed trades that do not align with the broader market direction. A common issue traders also face is over-reliance on a single time frame. Do not forget to use the right time frame. If you are a day trader, you should focus on shorter time frames like the 1-minute or 5-minute chart. Swing traders, on the other hand, need to look at weekly or even monthly profiles to understand the bigger picture. Using multiple time frames can also be beneficial, as it allows you to align shorter-term entries with longer-term trends, which can lead to better trade outcomes. Another mistake to watch for is failing to adjust your trading strategy during different market conditions. Volume profile can behave differently in trending versus range-bound markets. For instance, in a trending market, high volume nodes can act as consolidation points, whereas in a range-bound market, these nodes are more likely to represent solid support and resistance. Being flexible and adapting your interpretation of volume profile to the current market context is key to avoiding pitfalls. Finally, do not underestimate the importance of psychological factors. Many traders ignore how emotions can impact their interpretation of volume profile. It is easy to see what you want to see, especially when you are hoping for a trade to work out. Always approach your analysis objectively and do not force trades just because you see a volume pattern. Keeping a trading journal can help you stay objective and learn from past experiences by reviewing both your successes and mistakes. To wrap it all up, volume profile is an incredible tool that helps you spot key price levels where lots of trading action takes place. These levels can serve as support, resistance, or key points for breakouts. By combining volume profile with other indicators like moving averages, the relative strength index, or Fibonacci levels, you can make better informed trading decisions and improve your entry and exit points. Keep practicing and refining your strategy. It takes time to get comfortable with any trading tool, and volume profile is no different. The more you use it, the more you will see how powerful it can be in helping you spot high probability opportunities. Do not hesitate to ask questions or share your thoughts on what we covered. Let us learn together